Okay, welcome back. We are on the second video for chapter 5, which deals with inventory. And now in the first video, we looked at a bunch of inventory related knowledge items plus purchases. And now we're going to look at sales plus a few other inventory related items. So we're going to follow up where we ended up with purchases. Purchases, we talked about purchase returns and allowances and purchase discounts. Now we're going to look at those same items, but from the seller's side. So if we have sales returns and allowances, this is where we have sold something to someone and they have either we shipped them the wrong thing or it's broken or they want to return it for some other reason. So if we kind of go along with the example that I used in the other video, but we'll look at it from the sales side. So remember, the buyer bought something that was worth $1,200 on account. So here we're going to sell something on account. $1,200 sales revenue of $1,200. Now remember, on the buyer side, it's just something going into inventory, but here we have to record both the revenue price, the sales price, and the wholesale price, our expense. So let's say that the cost of goods sold for this was 40% of the sales price. So here, 40% of 1,200, that's going to be 480. And this is going to be our reduction in inventory. Remember, cost of goods sold is our expense. This is our revenue. Revenues minus expenses is our net income. So revenue is 480. And just remember that this part, what we bought it for, what the seller bought it for and is reselling it for, the wholesale price is not visible. In other words, they don't know how much of a profit that the seller is making. So this is not visible to the buyer. So we didn't see this particular journal entry on the buyer side. We just saw them adding to their inventory. So this was the initial sale. And remember, in our other example, the buyer returns $200 worth of stuff, right? So from our point of view, the return would look like this. From the seller's point of view is, well, we're going to have a sales, we're going to have, well, let's maybe map out the accounts first. First of all, we have an AR account, right, of 1,200. We've got a revenue account of 1,200. And if we kind of back this out, the $200, we can see where this is how much the buyer owes us. But if they return 200, they don't owe us 1,200. They will only owe us 1,000. So the first thing we're going to do is back that out of the bill so that the buyer only owes us 1,000. So that's going to be a credit to AR of 200. I'm going to leave blank here the account that we use for the other part of this one. Now this is the sale price. We want to look at, if we have to take back the inventory, we have to say, well, how much of this inventory are we putting back? Well, remember the inventory is worth 40% of the sales price. Remember, the buyer only knows the sales price. They won't know how much that is in wholesale cost. But for us, we do know. So 40%, the $200 times the 40%, means that we're returning $80 worth to our inventory. So that's what we do. We add back in the inventory of $80 and we remove this much of the expense. Now, what do we have here? You can see up to this point, inventory COGS inventory. That's a direct kind of flip, right? Here, AR revenue, and then we have AR blank. So the temptation is to believe that this is revenue. But in reality, this is one of those places that once we have a number, the business people are very reluctant to reduce that number. So they use a different method. Just like when we talked about purchasing equipment and depreciating it, that was a certain type of account called a contra account. Well, here we're not going to reduce the revenue directly. We're going to reduce it indirectly through a contra account. And this contra account is called sales, return, and allowance. and we will put that as a debit. So that fits the journal entry here. And what ends up happening is that, so this is a contra revenue account, meaning it works against the revenue account. And what it looks like in the income statement is that it would look like sales revenue. $1,200 less returns and allowances of 200, and now we're going to have a new number, or a new calculation, a new title. We call this net sales. And remember, whenever we're using the word net, we're basically offsetting a positive and a minus, a positive and a negative. So here, net sales is 1,000, which matches the AR, right? We're hoping to get paid 1,000 because we sold 1,000. Now, we don't do it directly of reducing revenue. We do it through this contra revenue account. Okay, so continue on with the example that we used in the last video. Remember, they initially returned stuff, and then they got, because they paid within 10 days, they also got a discount. So what does the discount look like from the seller side? So we offered, as the seller, 210 net 30, meaning 2% discount if paid within 10 days. And if you don't pay within days, everything needs to be paid within 30 days, the balance. And so 2%, now what do they owe us? They owe us 1,000, right? 2% times 1,000 means that the discount is going to be $20. So what does that account look like? Well, we're going to have cash, we're going to have AR. Now remember, whatever they pay us, we're going to get rid of the total bill that they owe us. So we're going to clear this bill. So the AR is going to be getting rid of the whole 1,000, but we're only going to be getting, what is 1,000 minus 20 equals 980, right? So we're going to be receiving 980 in cash. So what goes here? Well, we're going to have another contra revenue account called sales discount, another thing that reduces sales. And this is a debit as well. So this was the seller side. Let's look briefly at what the buyers, for the very same transaction, what did they have? Well, we, as the seller, got rid of the AR. The buyer got rid of their AP, right? A total of $1,000. And they paid cash of $980. And the seller received cash of $980. Here, the seller offset their revenue, right? The revenue went down. And the buyer reduced their inventory. Their inventory went down. So notice that the buyer and the seller, AP and AR match, the cash matches, but the other thing is a little different between the two. So what does that end up being? So again, we have an income statement, and we have sales revenue. If we're taking all of these transactions together of 1,200, we have less two items, returns and allowances of $200, and less a discount of $20, and that would give us net sales at this point of $980. And that would be correct, because we'd have this revenue account, we'd have this sales returns and allowance, and we'd have a discount, a sales discount T account, which would show 20. And the cash that we get would be $980. Okay, so that's the sales side of the return allowance and the discounts. Let's take a look at two other things, and we'll kind of bring up some more images here to go through them. The first one is, remember when we talked about perpetual systems versus periodic systems in the last video? Perpetual is the normal scanning system, where the scan measures is able to tell the price. It's also able to tell the wholesale price and is able to monitor and track the inventory. So under perpetual inventory system, we still use a physical inventory. And by that, I mean, when I say physical inventory, I mean, we physically go and count the inventory, not just trust the number on the computer system. We use a physical inventory to double check. So in other words, the actual amount on the shelf and what is in the computer might be slightly off, but this is a much better way to track it than the periodic system. So let's say in our computer system, it says that we should have $10,500 worth of inventory. But our physical inventory says, nope, we just have $10,000. Well, we need to say, well, this is because we just counted it. We need to maybe trust this one a little bit better. And something was missed in the inventory system, or we had shrinkage. So what do I need to do? I need to get this 10,500 down to the actual number, which is 10,000. So I need to take a credit. So I'm going to credit inventory of 500. And what do I write off that amount of missing inventory? Well, we're going to say it's expensed. It's a cost of goods sold. Even though we didn't sell it, maybe it was stolen, but you know, the stolen stuff we have to still incorporate in our total expenses as well, or the broken stuff, or maybe it went bad or something like that. Our next item is closing entries. So we're kind of working through the accounting cycle. We looked at the normal journal entries. We looked at the adjusting journal entries. Now let's look at the closing entries. And just remember, the closing entries, the purpose of them were to take all the revenue, expenses, and owner's drawings, although in this little example we don't have any of that, and reset them at zero. Because remember, those are measured on a yearly basis. What was our annual revenue? What was our annual expense? In other words, we don't keep carrying that forward over many years. At the end of the year, we reset it to zero, and then we say January 1st, we're starting over at zero revenue, zero expenses, etc. So we reset to zero. But now that we have a few more accounts, let's take a look at what the closing entries might look like now that we have some inventory accounts to take a look at. So let me bring that up here. Okay, so here we've got, and these are some images from the textbook. So if you're looking in the textbook, you'll see these, and so you'll be able to kind of match my explanation with the textbook example. So here we've got, remember that we're trying to take the revenue and the expenses, and how we did that was we first booked the revenue. So revenue is normally a debit, normally as a credit item, right? Normally. So to get rid of it, to make it to zero, we need to debit it. And what we do is we book it to income summary. And then we take all of the expenses. So these, in essence, we're not going to say they're all expenses, but they're all debit items. These are all normally debit items that we get rid of using a credit. So some of them are expenses. So we have expense here, expense here, expense here, and expense here. And remember, cost of goods sold is actually an expense. So that fits. Notice here, freight out, this is also an expense, but what happened to freight in? Remember, freight in is included in inventory. Remember that whole explanation of if we bought something on Amazon for $20 and shipping was $5, we would consider our all-in cost as $25. So the $5 got booked to inventory. So here we've got freight out as an expense, but there's no freight in because that is already part of inventory. These two are our contra accounts, but our contra accounts are designed to work against net income. And so here they're a debit, they're a credit against the income summary. So if we took 480, let me get rid of some of it. Maybe it wasn't worth it. If we take the 480 and we minus the 450, in other words, this was all the revenue, and this was all the revenue, and this was all the expenses and the contra accounts, then we would come up with 30. And that's exactly what's in income summary. So in order to put the income summary, we credit it to owner's capital. And then the owner's drawing, well, this wasn't exactly in the example that we had, but any owner's capital is booked directly from the drawing into the capital. So you notice that income summary, this is the same as net income. And so we add the net income to owner's capital. Remember, capital is an equity account, and therefore it is normally a credit, which is what it is. We're adding it. And drawings reduce owner's capital. And so therefore the drawings reduce is a negative or a debit to the owner's capital. So next here, we're going to look at an extended income statement. In last chapter, chapter 4, we looked at an expanded balance sheet called a classified balance sheet with current assets and long-term assets, current liabilities, long-term liabilities, all those sort of things. Here, we've gotten started on looking at a more sophisticated or an expanded income statement. So already in the purchases and sales, specifically the sales section, you notice that we have sales revenue that we already talked about, less the returns and allowances, and less the discount. And we have this new item called net sales. Okay, well, let's take a look at this total income statement and look at some of these other things. Cost of goods sold, you notice this expense is given its own line, because what did we say about merchandisers? That cost of goods sold was their largest expense. So we wanted to see, okay, if a merchandiser is buying and selling inventory, and this is the inventory that was sold, well, we want to get a sense of our profit just based upon our buying and selling inventory. And that basic level of profit is called gross profit. That is our net sales minus our cost of goods sold, which is our biggest expense. And then we go ahead and take out all these other expenses, these operating expenses, which we say were wage, utility, depreciation, freight out. I also had rent in there. And so we subtract that. So our gross profit was 11144. We take away 114. That meant our income from operations was 30. And then we have some other smaller ones, other revenues and gains, other expenses and losses. And when we say other, we basically say they're not directly related to running our business. They're not a cost of goods sold. In other words, they're not the buying and the selling inventory, and they're not expenses. They're not these type of expenses that are directly related to running our business. They're some other smaller thing, and we will learn more about them later on. Now, you notice that we are missing one thing in here, one expense that we will at some point figure out. And you'll notice that we haven't mentioned anything about tax, but we will add that later on. And at the end, we still come back down to net income. And last but not least, well, you're going to hear a little pinging. It just started to rain, and so it's hitting on my furnace. I'm making a little bit of noise. But last but not least, I want to just show you a section in the textbook that summarizes everything that we learned and the journal entries. So this is a pretty good, useful table that you can find. So you can see it talks about all the sales transactions, all the purchase transactions. So selling, here's a return and allowance, here's the freight in, here's receiving the payment, here's purchasing merchandise, here's the freight in based upon FOB shipping or FOB destination, here's returns, etc., etc. And then these are this is our physical inventory versus our perpetual inventory, and these are the closing accounts. And you notice it gives you all of the journal entries. So if you want to go to one place that kind of has almost all of the journal entries necessary for studying for quiz or an exam, this is a good one to look at or maybe print out and use as reference. Okay, well, that is the sum total of what we've got going on. In chapter 5, the homework is up, and you will see the due date that I made is going to be in a week. Okay, if you have any questions, let me know. Thank you.